Hello, and welcome to today's Center for Audit Quality webcast titled PCAOB Insights on Internal Control, a discussion on auditing standard number 5. I'm Cindy Fernelli, the Executive Director of the Center for Audit Quality, and I'll be your moderator for today's program. The Center for Audit Quality, or the CAQ, is an autonomous public policy organization serving investors, public company auditors, and the capital markets. Our mission is to foster confidence in the audit process and to aid investors and the markets by advancing constructive suggestions for change rooted in the profession's core values of integrity, objectivity, honesty, and trust. Based in Washington, D.C., the Center for Audit Quality is affiliated with the American Institute of Certified Public Accountants. CAQ membership makes a powerful statement about your firm's dedication to quality audits, and I encourage you to join today if you're not already a member, and be part of a group of approximately 800 member firms. We serve as the voice of the profession for public company auditing, representing firms of all sizes. We work to educate and inform member firms on issues that impact their public company audit practice in a variety of ways, including our technical alerts, the member-only section of our website, and through a host of other activities and events, such as today's webcast. For further information about the benefits of being a CAQ member, visit our website at www.thecaq.org and click on Members. Now, before I introduce our featured speakers and jump into today's program, there are a couple of housekeeping matters that I need to briefly discuss with you. First, we'll be taking your questions and conduct several polls during today's show. To submit your question, you'll see a question field in the lower portion of your screen. Just type in your question and click on the link labeled Send Question, and we'll stop at certain times and address your questions during the webcast. The polling will be done at different times during the program as well, and your participation will give us a useful snapshot of the participants' views. Second, the revised CPE standards require us to take attendance during the webcast to verify your participation. There have been some significant changes to the CPE rules. If you are claiming CPE credit in any state other than California, a couple of times during today's program, you will be given and asked to note 2 unique CPE program codes, each of which will begin with the word all. Once we give you each of the codes randomly during each segment of the program, you should immediately write them down and keep them with today's program materials. If you are planning on claiming CPE credit in California, it gets a little more complicated. The new California rules require you to have a certain number of interactions with us throughout this 2-hour program. These interactions will take the form of both polling questions and unique CPE codes. So be on the lookout for both the polling questions and the 4 CPE codes, and also write them down and keep them with today's program materials. Later on in today's program, we'll tell everybody how to do what you need to do and how to write down what you need to the information to document your CPE credit. Now let's move on to today's program. The Public Company Accounting Oversight Board's Auditing Standard Number 5, approved by the Securities and Exchange Commission on July 25th, is effective for audits of internal control over financial reporting required by Section 404 of the Sarbanes-Oxley Act for fiscal years ending on or after November 15, 2007. Early adoption is permitted. Thousands of smaller public companies, also known as non-accelerated filers, and their auditors are preparing to implement the requirements under Section 404 for the first time. These non-accelerated filers are required to provide management's report on internal control over financial reporting when they file an annual report for their first fiscal year ending on or after December 15, 2007. The auditor's attestation report on internal control over financial reporting for non-accelerated filers will have to be submitted when the company files its annual report for fiscal years ending on or after December 15th, 2008. Today's live interactive webcast will highlight important considerations as your firm implements AS5 for smaller public companies. It will also provide you with an overview of the SEC's management's guidance on internal control and COSO's draft guidance on monitoring internal control. We've got a great deal to cover today, and to help us gain a better understanding, we have put together a panel of wonderful experts. Let me take a moment to introduce today's presenters. First, we are very lucky to have with us Tom Ray. Tom is a CPA and the Chief Auditor and Director of Professional Standards for the PCAOB in Washington, D.C. His principal responsibility is to advise the PCAOB board members on the establishment and application of auditing, quality control, ethical, and independence standards applicable to audits of U.S. public companies. So, Tom, we're thrilled to have you with us today.
Thanks, Cindy. It's really a pleasure to be here.
Next, we have Sharon Virag. Sharon is also a CPA, and she serves as the Director of Technical Policy Implementation for the PCAOB. Her principal responsibility is to facilitate entity-wide implementation and coordination of key technical issues. As a member of the Office of the Chairman, Sharon works closely with PCAOB board members and division leadership teams, overseeing the board's entity-wide efforts related to the implementation of Auditing Standard Number 5, as well as the implementation of other key technical policies of the board. Sharon, it's a pleasure to have you here with us as well.
Thank you.
Finally, we have Trent Gazaway. Trent is also a CPA and the Managing Partner of Corporate Governance for Grant Thornton. Trent's experience includes auditing public and private companies and assisting an array of companies in the improvement and documentation of effective systems of internal control. Trent was also appointed by the board of the Committee of Sponsoring Organizations of the Treadway Commission, or COSO, to lead a project to develop guidance regarding the effective monitoring of internal control in accordance with COSO's Internal Control Integrated Framework. This guidance was recently released for public comment, and we at the Center look forward to commenting later this month. So, Trent, it's good to have you here with us, too, this afternoon.
Thank you, Cindy. It's good to be here.
Over the next few minutes, we will introduce 2 poll questions to which we would like you, our viewers, to respond. These poll questions will be introduced throughout the program and stay up on your screens for about a minute and a half each. So please cast your votes quickly. While we would like all of you to respond, it is imperative that California CPAs respond because it is part of the CPE documentation that's required. So our first poll question is, how much experience does your firm or organization have auditing and implementing internal controls over financial reporting? Your response choices will be very experienced, somewhat experienced, little experience, no experience, or don't know, not applicable. As I noted before, once we put the poll question on the screen, we will give you a minute and a half to respond to that particular question before we put up the second question. So please quickly cast your votes. The second poll question will be, do you believe that the auditing standard on performing an audit of internal control over financial reporting is scalable to smaller, less complex companies? Your answer choices will be very scalable, somewhat scalable, not at all scalable, or don't know, not applicable. While participants are answering these poll questions that will go up on their screens, let me kick things off with a few questions to our guests today that will help set the context for today's discussion. So the first question that I'd like to ask all of you is, do you believe that the implementation of Section 404 for both auditors and preparers will be much more efficient for non-accelerated filers and their auditors than it was for the first-time implementers back in 2004? I think that's the question that was on everybody's mind as the PCAOB looked to revise that standard. So Tom, let me turn it over to you and get your thoughts on that.
Sure, Cindy. You know, there's a number of developments that have taken place since the implementation of Auditing Standard number 2 and throughout that implementation process, and a number of things in place now that should make this process easier for non-accelerated filers, those companies that haven't had to apply this yet. One is we have a new standard on internal control audits. It's shorter and simpler. Second, there's additional guidance out there available to companies and auditors, and more in the works. And thirdly, I think probably most importantly, both regulators and auditors have had a tremendous amount of experience dealing with internal control in a way that they haven't in the past. So all these things should help that implementation process.
And Trent, I'm curious from an auditor's perspective, what do you think about that question?
Well, I think Tom is right. I think a lot has happened over the last couple of years to make the entire process more efficient. I think one of the primary reasons that the initial implementation of Section 404 was so costly, excessively costly, was that there was a lack of general, consistent understanding about what it takes to, what level of effort is necessary to get comfortable that internal control is working effectively. And I think we're learning how to, what that level of effort should look like. And so I think we're going to be more efficient. I think things like AS5 and the work that the SEC is doing, and hopefully what COSO has worked on is going to help foster that.
Yeah, and I know you're going to talk a little bit about COSO later, so I'm looking forward to that. Sharon, do you have anything that you'd like to react to that either Tom or Trent said, or add anything further?
No, I think that Tom and Trent summarized exactly the benefits that's going to happen going forward with just all of the knowledge, the new guidance, the training people have had over the course of years, and all of that experience is going to go forward to really make this a better process.
Excellent. For our audience members who are about to undertake implementation of the new auditing standard on internal control over financial reporting, I'd like to ask each of you in turn to elaborate on whether AS5 is scalable for those smaller, less complex companies who do not have adequate segregation of duties or things of that nature. Very much goes to our first poll question, and as we're tallying those, I'd be curious to know what you all have to think about that. So Sharon, I'll start with you this time.
Well, I think the scalability in the standard is more than just the attributes and some of the specific examples we gave of how to tailor the audit that was included in AS5, but the basic principles in AS5, the top-down approach, the risk focus in the standard, I think those are really going to be of the most benefit to scaling, really draw a picture of this should not be a one-size-fit-all. It should be, scalable to any size company and more appropriate to that specific company.
Trent?
I think I've said this before many times in the past, but the way General Motors implements and evaluates internal controls, by definition, is going to be different than the way Joe's Motors implements and evaluates internal control over financial reporting. And so, since the way they implement and evaluate internal control is different, the way auditors audit it is going to be different. So I think the answer is that AS5 has to be scalable for smaller companies. We cannot treat the smallest companies the way we treat the largest companies. We can hold them to the same quality standard, but not the same way to get to that quality.
Mm-hmm. I think Trent makes a really good point here. I think one thing that's become even more clear over the last few years is that internal control over financial reporting is not one size fits all. Smaller companies can have different controls than larger companies and still have effective internal control over financial reporting. It's important for auditors to recognize that. Mm-hmm.
Great. Before I move on, because I do want to go around the table and have each of you explain a little bit about what our participants can expect today, I do want to go ahead and let you know that the results from our first poll have come in, and so I'd like to share those with you, because I was curious about these numbers, and I think you all probably are too. And again, the question was, how much experience does your firm or organization have auditing and implementing internal controls over financial reporting? And a majority of our respondents do have at least somewhat experience with that. 29% said they had a lot of experience or were very experienced. 43% were somewhat experienced. 19% said that they had little experience, and only 4% said that they had no experience. And then 5 answered don't know or not applicable. So an overwhelming majority do have at least some experience over this. So I think today's program will be very, very helpful to them. So what I would like to do is just take a moment, go around the table, and have each one of you give us a highlight of what it is that you're going to talk about today and what our participants can expect. So Tom, I'll start with you.
Thanks. Well, as I said already, we have a new standard on auditing internal control over financial reporting. The PCAOB has learned a lot as a result of the implementation of Auditing Standard Number 2, and I think we've done a good job reflecting that in the new standard. So I'd like to highlight how the standard has changed to reflect that knowledge and experience. And also, it's important for us, for auditors, to focus on those things that are most important to internal control, and I'd like to talk a little bit about that as well.
Great, and I'm sure our participants will love to hear what you have to say. Sharon, how about you? What can we expect to hear from you today?
Well, I'd like to go in a little more detail about a few of the different areas, the objectives that the board had, and how those have been brought through to AS5. For example, the elimination of some requirements that might change the procedures or eliminate some procedures that the auditor might have been performing, how we've scaled it in some more specific detail. And I'd like to talk a little bit about what we're doing, what the PCAOB is doing to work towards better implementation of AS5.
So, and Trent's going to give us the auditor's perspective, but if you could give a little more specificity about what we might expect to hear from you today.
Sure, and well, the way I look at this, what we're covering today is I look at it as a three-legged stool to improving 404 implementation, and I have a slide on that a little bit later. One of the legs to that stool is the rewrite of AS2 in the form of AS5. The other two legs, I think, come in the form of the SEC's management guidance and COSO's guidance on monitoring internal control. And from an auditor's perspective, what I want the auditors out there to see from the SEC's guidance and COSO's guidance is a better flavor for what good internal control looks like in principle. And that's important. We're talking about principles here. So that they can focus their audit of internal controls on those things that are most important.
Okay, well, as you can hear, we have a lot to discuss today. So with that, let's just jump into our program. So what I'd like to do is turn it over to Tom right now. I believe we're going to start on slide number 5 for those of you that are following along. So Tom, I'll kick it over to you.
Thanks a lot, Cindy. Let me start out by pointing you to slide number 6. As you'll notice on that slide, the views that Sharon and I expressed today are our own views, and they don't necessarily represent the views of the PCAOB, the board members, or other members of the PCAOB staff. As you'll see on slide number 7, what Sharon and I would like to cover are, broadly talk about improvements that we've made moving from auditing standard number 2 to auditing standard number 5, and talk about some of the details in there and give the listeners some insights on applying that new standard. And then talk about the next steps, the program that PCAOB has to help to facilitate the implementation of auditing standard number 5. So moving on to slide number 9. As I have already said, we gained a lot of experience and knowledge as a result of the implementation process. The PCAOB dedicated a lot of resources to monitoring the implementation of auditing standard number 2 through our inspections process, through continuing dialogue with members of the firms that were applying auditing standard number 2, and talking with issuers and investors and others. As a result of that, we received a lot of feedback. And in addition, we received a fair amount of criticism about that standard and the impact it was having on auditors, in that in some cases the standard itself appeared to be driving the auditors to perform procedures that really weren't adding value and really weren't resulting in the benefits coming from the internal control audit. So one of the things we did in moving from AS2 to AS5 was to focus on whether all the requirements were necessary. And I think we were very successful in eliminating requirements that we think were driving procedures that really weren't adding value to the process. Second, we've already talked about scalability, very important. We've got a new internal control standard that provides a framework that applies to all audits of internal control for all companies who have to comply with Section 404 of the Sarbanes-Oxley Act.
And Tom, since you mentioned scalability, the results of our second poll about scalability are in. And as you recall, we asked whether or not our respondents thought that financial reporting, the internal controls over financial reporting were scalable to smaller, less complex companies. 17% thought that the new standard was very scalable. An overwhelming 69% thought somewhat scalable. So that's the combination of somewhat or very scalable. Again, overwhelming response there. Only 7% thought that they were not scalable, and then 7% had no opinion. So those are very impressive numbers.
That's very encouraging. But scalability, as you said, is very important to us, and we believe the standard is very scalable by virtue of the way the standard is drafted, as well as by virtue of some additional direction that the standard provides. We also simplified the standard. It's far less lengthy than Auditing Standard Number 2, and there's far less prescriptive direction in that standard. We found that auditors really could rely on the principles that are articulated in the standard rather than needing all of this additional prescriptive direction that was in Auditing Standard Number 2. So this should allow auditors to exercise more judgment and then be able to scale the audit accordingly to the facts and circumstances of each engagement. And then importantly, we want the auditors to focus on the most important matters. As a result of, I think, the three things I just covered, auditors should be able to recalibrate the amount of work they were performing in the lower risk areas in particular, and then be able to focus more of their attention on those aspects of internal control that are really most important. Which goes on to slide 10, and maybe I should talk for a couple minutes about what are some of those important aspects of internal control. Well, of course, one of the things we want auditors to do is to better focus their attention, have a better chance of identifying material weaknesses before they result in a material misstatement of a company's financial statement. So that's what really all of this is driving towards. And one of the important ways we do that is through implementing this top-down risk-based approach into the standard itself. So really everything about the standard brings in the concept of risk. One example is as the auditor begins to identify what we call significant accounts and relevant assertions. An assertion is not relevant if it doesn't possess a reasonable possibility of causing the financial statements to be materially misstated. So if there's a low risk that an assertion could actually cause the financial statements taken as a whole to be materially misstated, then the auditor doesn't need to worry about that assertion. So right at the beginning, we're trying to get the auditor to focus not on those things that are insignificant, but on the parts of the financial reporting process that actually pose the risks.
And I applaud the PCAOB for doing that, because we hear so much about risk and risk assessment, but to have real, tangible things to do and to carry out, I think, behoove and help us all.
And then, I talked about focusing on the important matters. One of the very important matters to me and to the PCAOB is fraud. What is the company doing to address the risk that there could be fraudulent financial reporting or frauds that would result in materially misleading financial statements? So we want the auditor to think specifically about that, and we provide some examples in the standard on what we're talking about. For example, are there controls that address the risk that management may override other important controls in the internal control environment? What kind of controls are there over related party transactions and significant management estimates, for example? Also, we explicitly require that the auditor should take into account the auditor's fraud risk assessment when they're going through this process of identifying the significant accounts and relevant assertions and the controls that need to be tested. Moving on to slide 11, we also recognize that entity-level controls play a very important part of the effectiveness of a company's internal control over financial reporting. So we provide some additional emphasis on entity-level controls. And further, we describe 3 broad categories of entity-level controls to help auditors understand how to look at them and to understand their impact and effect on the company's internal control over financial reporting. And I know Trent and Sharon both, I think, are going to talk about entity-level controls. One of those areas are the control environment controls. Again, very important. Tone at the top. Explicitly, we are asking the auditor to evaluate, well, what's the ethical tone that management is setting? Is honest and fair financial reporting important to the company and to management, and is that carried throughout the organization? We also emphasize a couple of other areas, one of which is the period-end financial reporting process. Now, AS2 emphasized this as well, but I think we bring even a little bit more emphasis to it. This is an area of the financial reporting process of any company that poses a very high risk. There's a lot of points throughout that process where misstatements could enter into the financial reporting, so auditors really need to be focused on that period-end financial reporting process and the controls that exist around it. So with that, I'd like to turn it back to you and over to Sharon to talk a little bit more detail about some of the things I mentioned as well as others.
That's great, and thank you for that. I think that the PCAOB has done a good job of taking all that auditors, preparers, the board, the staff saw over the last couple of years and really refined the standard under new AS5 to make it much more applicable, scalable, relevant to everybody. So Sharon, hopefully you'll give us a little more flavor of what some of that actual changes were.
That'd be great. What I'd like to do is drill down a little bit more, starting at slide 12, into what kind of requirements were changed in coming from AS2 to AS5, and how that might eliminate some procedures that were being done under AS2 that are not necessary under AS5. We think it's an interesting thing to go through and to identify things that in AS2 were being required and procedures that might have been done under there and say, okay, we don't need those. I'm particularly pleased with the process that the board went through in identifying those, the willingness to say, let's start from the very beginning. Let's re-challenge everything we did, not start in the 10th chapter of an 11-chapter book and say, we're just going to rewrite the ending. We wanted to start from the very beginning. And it was a long process, but I think we were able to identify some things that will really make some improvements. And I have a long list of them, but let me just go through some of them. First is removing the detailed requirement to evaluate management's evaluation process and what that means. First, in AS2 there were some paragraphs in there that required the auditor to do specific things looking at management's process. Now we know that the auditor has to be concerned about management's conclusion. That's the management's assessment on internal control is their conclusion, and the auditor needs to be concerned with, well, what conclusion did management come to, what material weaknesses might they have disclosed, and what did the auditor find? And the comparison between those two is obviously very important. But the process that management went through, the question is, how involved does the auditor need to be in looking at that process itself? And in the end, after looking at the requirements we had in AS2, we determined that you weren't going to need the auditor to be looking at the process in order to evaluate it. Now, that doesn't mean that the auditor is not going to have anything to do with management's assessment. Obviously, there's a lot of benefits to be obtained from spending some time with management's assessment and coordinating early on in the process with management. By looking at what management did, you can get a jump start on, for example, your documentation, the auditor's documentation of the internal controls there. You can get a jump start on the risk assessment by looking at what management did. And then, of course, there's the using the work of others. And so the more time that the auditor spends looking at the work that management do and identifying opportunities for using management's work, obviously the more efficient the audit's going to be. So it's definitely involvement of the auditor, but it's not in an evaluation type of role, which we think is an important improvement.
Sharon, you're touching on, I think, management and the auditors in certain instances being aligned and coordinating and talking to one another. To what extent does the SEC's management guidance and the PCAOB's AS5, to what extent are those aligned?
That's a good question, and something we were really paying attention to, especially after we put out the proposed comments, and that received so much prominence in the comments. We were really focused on that for the final version. The most important thing in our minds to get aligned, that needed to be the same, was the terminology, the definition of material weakness, entity level controls, and I know you're going to talk about that a little bit later, Trent, and I think those things had to be in alignment. You have to have management and the auditor kind of speaking the same language. What we didn't want to see get aligned was things that ignored the perspective of both parties. The auditor is coming from the outside. They should be looking at it differently because they don't have the hands-on day-to-day knowledge that management has. The auditor should be able to come in and do things based on prior year knowledge and their own familiarity, but not coming in and assuming that they have the knowledge of all the changes that took place. Management, on the other hand, does have that benefit, and how valuable that is, that they've been there through the process. They see their different processes changing over time. They're familiar with their controls and how all the interaction happens between the various parties in the company. And so we think it should be different, and that the requirements should be based, which was why it was such a great move that the SEC put out guidance that's specific, because of that very clear message that these are not the same. One auditing standard should not be driving both processes. It should be different, and people should be looking for differences there.
Well, I just wanted to add, I think it also is reflective of the fact that there are different responsibilities. Management of the company has a responsibility to implement and maintain effective internal control, first and foremost. The auditor's responsibility is to come in and provide an independent opinion about the effectiveness of the internal control. So I think the differences reflect that difference in responsibilities.
And I, as the moderator today, have a responsibility to give out those CPE codes. And so let me just jump in here for a moment and tell our viewers that we're going to go ahead and put up on their screens the first CPE code. Everybody should write this code down and keep it with today's materials. And that code is ALL4PC5. Again, that's ALL4, P as in Peter, C as in Kathy, 5. And again, we'll tell you later on in the program how to use this information to document your own CPE credit. So Sharon, back to you.
All right. Well, the second thing I'd like to talk about a little bit is the change that permits the consideration of knowledge obtained in the previous years. Now, this is a big change from AS2. There was a statement in AS2 that each year's audit must stand on its own. Now, that didn't mean that you couldn't bring forward documentation and things, but there wasn't a lot of, I want to look at the test results from last year and decide whether the results of those testing should change what I do in the current year. And so we think that's an important addition to the standard. Now, as it built into all of that risk assessment that the auditor is doing all the way through the process, they can now take the results of the previous year and factor those in and start saying things, looking at things like, did the process change? Should it have changed? If the company itself changed, should they have been doing something different, and should you have seen results in the controls changing? What were the results of last year's testing, and what testing was done last year? Maybe a lot of testing was done in the prior year, and the results of that testing, the results of the financial statement audit, pull all that together, and how does that change your assessment of the risk? And that's an important part of continuing this risk focus. Of course, as you're going through it from an effective standpoint, you're looking at effectiveness only, of course you want to know all of those things. It has the benefit of efficiency where things were good in the past, where the financial statement audit showed no deficiencies, where the internal controls had no deficiencies, where there hasn't been change, then you can look at it from an efficiency standpoint. I might not have to do as much work this year. Almost analogous to rolling forward the testing from the prior year. And we think that has a lot of opportunity to really continue that risk focus and move forward year from year.
To emphasize just one point about risk, the auditor's risk assessment doesn't affect, well, it affects both the selection of the controls that the auditor believes that they need to test in the audit of internal control, and it also affects the amount of work that the auditor needs to perform on each control that's tested. So it can have a very powerful effect on the amount of work that's necessary in the internal control audit.
Okay, moving on to slide 13. the third was removing barriers to using the work of others. Now, the underlying principles in the using the work of others, we're still focused on the risk related to the work that's being done, and then we're focused on the objectivity and competence of those who performed that work. So those basic principles came forward. What didn't come forward was something that was in requirement that was in AS2 that required that the auditor obtain the principal evidence for his or her opinion himself or herself. This requirement was probably the most misunderstood of any piece of AS2. And I remember on the speaking tour explaining this concept to people, trying to explain this is not a quantitative thing. This is not 51%. And we heard some people who took it as the entire audit had to be 51% performed by the audit. Some people actually thought it meant by control, 51% of the testing for that control had to be done. And we tried for a long time to unweave that, and we were unable to. And so I think it was a big move to take that out of the standard, to say, throw that concept away, and now rethink of it as you're concentrating on the risk involved with the areas you're doing. The areas that are low risk, you're going to be able to use more. The areas that are high risk, you're going to be able to use less. You need to think about the objectivity and competence of those individuals and bring that into your decision on how much to use them. And I think it was really important to get rid of that statement because it was misunderstood. I don't know that there doesn't have to be some thought of that, of course. The most high-risk areas, the things that are the most contributing the most to the auditor's opinion and are most important to it, the auditor is going to obviously care about doing more of that work himself or herself. And so it was a big change, and yet in some people, to people who really understood and grasped what we meant by principal evidence, maybe it's not a big change. But we were glad to make the decision to do that. The next thing is refocusing the multi-location direction on risk rather than coverage. This was probably one of those things that you spend, it took 2 hours to redraft that section. It was probably the easiest to redraft, focusing it on risk, getting rid of the multi-step process of going through and segregating out different locations. And probably in the immediate impact of AS5, probably what we've heard is one of the most biggest improvements and the things that people were able to right away implement. And so it's just interesting to me that we spent so much less time on that area, and yet it's had such a big impact. And I think it's been really strong, the response we've heard from people. Finally...
I'm sorry to cut you off. Just to point out, this was also another one of those areas where AS2 had sort of a redundancy. We had principles that articulated how the auditor would go about selecting the locations to test and how much they needed to test them. And then we also had one of these other rules that said you needed to cover a large portion. And that, we believe, had driven some auditors to do more work or do testing at more locations than what was really necessary. So we eliminated that large portion test. And now we do believe that just applying these risk principles the auditors are going to be able to do will do sufficient work to support their opinion.
And which also goes back to scalability, right? Depending on the risk of the company, depending on the particular facts and circumstances of that company, is the auditor uses his or her judgment to decide how much or how little to do in a particular area.
Well, just echoing what they both said, that this change garnered some of the biggest cheers from our partners as well. Because this was one of the places where they really felt like, in some cases, they were performing testing where they were only performing it because they felt like they had to, not because it really helped them sign their opinion. And they've done a good job of creating the standard in such a way now that the audit partner has the flexibility to do what is necessary to sign the opinion and to get comfortable that internal control is effective. So.
All right. The third thing here, and it's an interesting thing, we talked about the top-down approach, and Tom, you mentioned it in your focusing on the right thing. This seems like a small thing that we're talking about. The top-down approach describes the auditor's sequential thought process in identifying risks and controls to test, not necessarily the order that people will do it in. And I think that that's an important, adding that to me is important because it highlights how important the top-down approach is. It's not a matter of dating on the work papers or the auditor having to plan it to get certain things done in a sequence. It's really the thought process and the perspective of the auditor as they're working through this, always kind of going back. Let me go back to the top and think through this. I've got my entity level controls. Now I'm looking at where I need to focus my attention at the process level controls, and kind of you almost have to re-challenge yourself as you learn more throughout the process. So it's really not I'm going to start the top-down approach on day one and work through it. It's really just a mindset that you keep going back to, and so I thought that was an important change in the standard that I wanted to highlight.
And Sharon, as you're talking about these changes, again, both you and Tom mentioned several times throughout today's program so far about risk assessment and looking at risk. And Tom, one of the things that you mentioned was the tone at the top, or the ethical culture within a company at the top of their management structure. And we have a question from one of our participants who was wondering, how is it that an auditor can assess the ethical integrity of management, of senior level management? Oftentimes, particularly I think in small companies, senior management can be very charismatic, very much people oriented, and so what is it that the PCAOB expects, and what is it, Trent, that you do out in the field to help do that assessment and get a good feel for what the tone at the top is?
Well, this certainly is one of those areas that's a little softer than looking for a specific kind of a reconciliation or a control of that nature. But certainly, I think it's something that auditors should use their previous experience with management to help them form that assessment. Have some dialogues with the people who are responsible for financial reporting about their philosophy of financial reporting, talking with the lower level people about their responsibilities and getting a sense as to how seriously they take their responsibilities, whether it's acceptable to them or others within the company to not adhere to a procedure or policy and things of that nature. But I'd really be interested to hear from Trent as well as to what kind of things that auditors are doing in the field.
Well, I think you're absolutely right. This is one of the softer areas to deal with. This is one of the first entity level controls that we talk about in the 3 levels of entity level controls, and we'll talk about it more in a little while. I haven't found a company yet that, when asked the question, do you have good tone from the top, they say, no, we have terrible tone from the top. And, when I go around and talk to our audit partners, we have risk questionnaires that we fill out in our client acceptance and retention decisions. And I don't find too many where partners are suggesting that we take on a client and they've indicated that they have poor tone from the top. So that would indicate, of course, that all of our clients have perfect tone from the top in all of the firms. I think we have to, and what we try to tell our partners is you have to get out of that pure gut level mindset that says, yeah, I like working with these people. These are good people to work with, and you have to get behind that. And I think the way you get behind that is you see what they do. And so, for example, if you found a situation in the organization where somebody violated a policy, how did the organization handle that violation of the policy? Did they actually take proper corrective action, or does it look like they treated people differently because of their position in the company? I knew of a company many years ago that caught an individual, one of their top salespeople, cheating on his expense reports. Now, of course, it was against the company policy to cheat on your expense reports, but because he was the #1 salesperson in the organization, they just said, don't do it again. And 6 months later, they caught him doing it again, and they still didn't terminate him or take any significant corrective action. Well, that sent a ripple effect throughout the organization. It just sent the wrong message. And so what we try to tell our partners and our managers is you need to look at what they do, not just what they say. Enron had one of the best code of conducts out there. When you read it, I use it in presentations all the time with the name blacked out, and it's perfect until you get behind it and you see the actions that actually took place. So it's soft, but there are things that you can do to determine whether or not they have proper tone from the top and ethical culture.
Mm-hmm. Well, that's helpful because I think it is one of those soft areas. We do have another question that's probably less soft, but important nonetheless, that we've gotten from our participants, and that is, what is the extent that auditors need to evaluate management's process and the veracity of its reports? So what does the auditor need to do vis-a-vis the management's assessment under AS5?
Well, let me start with that, and others might want to jump in here as well. The AS5 takes the approach that the auditor should focus on the subject matter, on whether or not the internal control over financial reporting is or is not effective. So the auditor's planning and performance is directed to that. Are the controls in place that are necessary for effective internal control, and are they operating effectively? And once the auditor gets that evidence, then you can compare the result to what management has reported, and is it the same? For example, if management says my internal control is effective, but the auditor found material weaknesses, then there's a disconnect there. Now, from a practical perspective, and I don't want to lose this point, we do think looking at what management has done is naturally a good place to start, because that's just going to, as Sharon said, that's just really going to help the auditor understand what's going on and do the job much more efficiently.
Sharon, before we turn back to you to pick it back up on the slides, let me give the other CPE code that we will do. We've got several to come, but in this segment we need to do another one. And that is CALIF 05. That's CALIF 05. So again, mark that down, keep it with today's materials, and we will give you instructions later on as to what to do with that. So Sharon, back to you on the slides.
Okay. Well, starting back on slide 14, that top bullet I think I've kind of talked about a little bit, that you're allowing the auditor to tailor their top-down approach to the facts and circumstances of a particular engagement, very closely tied obviously with the scalability, and even in a large company that you're looking at all the facts and circumstances to work through that top-down approach. Also like to talk about walkthroughs. One of the things that was required in AS2 was a walkthrough, and we played at the proposal stage, we played with whether it should be a walkthrough of every significant process or major class of transactions, and based on the comments we received, we took the opportunity to look at what were we trying to achieve with that walkthrough, and as you start to think through that and try and figure out, well, should it be on the process or the transaction, what are we trying to achieve, it started becoming clear that the walkthrough is not the issue at all. What's really at issue is, are we understanding the points in the process where things can go wrong? And are we making sure that even though we start with our risk assessment, we understand what we think the risks are to the financial statements, have we made sure that at the process level, where things are really happening, that we've covered all of those risks and that we know them all? And so what we think is there's some objectives that the auditor needs to be focused on, and fulfilling those objectives can happen in different ways. In most instances, or in many instances, a walkthrough is a good way to do that. When you start looking at what those objectives are, you can see how a walkthrough would get you there. In other cases, there may be instances where you could achieve those in other ways, and we wanted the flexibility to be in the standard by stating what were we trying to achieve and that the auditor needs to meet those objectives, but leaving how they go about that with more discretion for the auditor. We think that's going to be a good balance of the flexibility but maintaining the quality.
Sharon, would you say, when I try to articulate what I believe the objectives of a walkthrough are, I think one, it's to get people out of the accounting department and get them out into the operations of the company so they really understand what is actually happening out there, not what they believe might be happening, but that they really understand what's happening in the operation of the controls.
Right, exactly. Exactly. And that's why I think, the probing questions that are part of the walkthrough were in AS2, were in the proposed. I think those really, to me, are how you get that information. You're doing more than looking at a flow chart or something like that. You're up, you're out, you're moving around, and you're talking to people. And that interaction is really where you really learn and you really get that additional information. Second is, or next I'd like to talk about the Principle for Evaluation and Communication to the Audit Committee of Control Deficiencies. It was a change that we made, which is an interesting one, to eliminate discussion of significant deficiencies throughout the standard until you get to the communication requirement. A significant deficiency, the auditor needs to communicate to the Audit Committee any significant deficiencies that they have identified through the course, but they shouldn't be planning to find them. And that was an important part of an important change throughout to remove it from there, to make sure that the mindset is correct. You're looking for material weaknesses. Stay focused on material weaknesses. We do think that communication at the end is vital. If you have that information, you should share it with the audit committee in addition to management. And we thought that was a great communication requirement, but wanted to make it really clear to people you're not focusing on significant deficiencies.
This is an area in the communication of significant deficiencies that I do get a lot of questions from our partners, because the requirement now is to communicate as significant deficiencies those things that would be meaningful to management, to the audit committee, things that the audit committee should hear. There's not a quantitative calculation that says you crossed a threshold, this is now a significant deficiency. And so our partners naturally want to know, they want to make sure that they're not leaving a significant deficiency off that should be on the list. And what I've told them is, you really, and what we've tried to teach them in training is, you have to put yourself in two different positions. Ask yourself, if you were on the audit committee, would you want to know about this particular issue? And ask yourself, if you were an investor, would you expect the audit committee to know about this? Would you expect them to inquire about this? And if the answer to either of those two questions is yes, then you need to report it probably as a significant deficiency. So.
Right.
Sharon, I know you're going to talk a little bit about scalability, but before we move off of this section, we've had a couple of questions from some of our participants that I think we would all benefit from hearing your and Tom and Trent's perspective on. You had mentioned earlier that with respect to roll forward of testing from the prior year, in low-risk areas, are you suggesting that you may not have to test the controls in the current year, depending on what you saw in the last year?
Well, the easiest way to address that is to take the subject of rotation head on. So let me just do that. There's a lot of people questioning, is rotation allowed under AS5? The answer is no. If you're defining rotation as taking one piece, a third or two-thirds or whatever of the entire controls of the company, taking those out and not looking at them in a year, then no, rotation is not allowed. And the reason is that auditors are giving an opinion on internal control as a whole. This isn't something that's supporting the financial statement audit. It's something that is direct to that subject matter. So the idea that the auditor could give that opinion without looking at those controls at all during a period is probably just not, it's not correct. So, but how can we leverage that information from the prior year? And I think that's an important part of why we set it up the way we did. You should be able to look at those and bring them in. You do need to make sure this idea of, what were the results in the prior year, but have there been changes? And should there have been changes? That's going to require some level of work, making sure, just like in roll forward, when you're rolling it forward, you don't roll it forward by doing nothing. You roll it forward by doing some maybe lesser amount of work to make sure that your assumptions from before are carrying forward and that you have the information. And that's the same idea with this section, special considerations on prior year audits, is looking at that, doing enough testing to assure yourself that the conclusions you reached in the prior year would carry forward to this year. And in some cases, that amount of testing may be very low, but they should do something in each year.
And then another question that we've gotten from a participant is, what qualifications, education, certification do auditors need to consider when evaluating the work of others? Or, to put it a less specific way, what should auditors be looking at when they evaluate the work of others?
Go ahead.
Okay. Well, they need to be using we did not go with a new standard on using the work of others. We stuck with what the new instruction that's in AS5 and the work that was in AU 322. And so they should be looking at those. There's some specific requirements in there that talk about things like their education, talk about their experience, how familiar they are with internal controls, and those are the things they really need to focus on in making that decision. Now, it gets really interesting when you have a huge body of people. Are you going to each specific one? And the auditor really needs to assess what do they already know about it, and how much in depth they need to do testing for that, kind of based on the facts and circumstances of the prior work they might have had with those individuals, the size of the organization, and really determine how much they need to do there.
I think the topic that they're dealing with is important to keep in context. If you're evaluating internal controls around derivative accounting, then the individual needs to have some experience and understanding in derivative accounting. If it's a valuation issue, they need to have some experience and understanding about valuation issues.
Absolutely.
Okay, very good. And then I had one other question from a participant, which was the focus on this year for non-accelerated filers who were doing the 404A report when auditors are not performing the audit required by 404B and AS5. What is the auditor's role in that, the management's 404A process?
Well, from a very technical perspective, the auditor should, at a minimum, find out what the results of management's assessment process were. Did management conclude that they have effective internal control, or did they identify material weaknesses? If they did, what are they? Did they identify other significant deficiencies in internal control? Because that information could have a bearing on the auditor's financial statement audit. So I believe the auditor, at a minimum, needs to be concerned about looking at what management found.
Yeah, I think it certainly informs the auditor's own risk assessment process. It would be inappropriate for the auditor to assess control risk at low in a given place where management has identified material weaknesses in internal control. You would want there to be some consistency. And vice versa, if management has identified that internal controls in a given area are very strong, then the auditor might consider making some modifications, of course doing their own testing to assess control risk at low, to be able to modify their substantive audit procedures as well.
You know, this phase implementation actually gives auditors really a great opportunity to leverage off of management's process in the first year to help them sort of jumpstart their first audit that has to take place in the next year. So it's an opportunity auditors really should take advantage of.
All right, well, just to jump to slide number 15 and talk a little bit about the scalability. We discussed a little bit about how there's concepts coming straight from the standard related to risk assessment, top-down, that'll make do a lot for the scalability. But then there's also some things that we've put specifically into the standard, and they're kind of baked throughout and sprinkled through there. But there are concepts related to what are the attributes of a smaller, less complex company, so that as part of the planning, the auditor is thinking about those attributes, identifying them, and what are they going to mean to the audit process. And then throughout the standard, we've included some things, some kind of tailoring hints, things you're going to want to think about when you get to this part. You're picking your significant accounts and relevant assertions, and you're determining how much work you're going to do. You should be thinking about these if you're in that smaller, less complex. We were fortunate to have the work of the small company auditor guide that we're going to talk about in a little while, and we were able to really leverage off of that. So people will see very consistent taking those themes out of AS5, and you'll see those kind of carried through in the guidance and discussed more broadly. So these are kind of the principles are in the standard. People can have assurance that it's part of the standard, it's baked in there, and then later on they'll get the more detailed guidance. Okay, so to move on, simplifying the standard, I think Tom mentioned this earlier. We thought it was important to kind of unbury some things, get people focused on the most important matters, and one of those was unburying the most important steps in the audit process, reorganizing it to follow the top-down approach, simplify it so that management is able to understand it and make sure there's no technical terms in there, so that there can be a more open dialogue, especially in that coordination part I keep mentioning that we think is so important, that management and the auditor are coordinating what they're doing. And so by making, certainly the SEC management guidance, we want the auditors to read that, be familiar with what management's doing, and then to the extent that management wants to read AS5, make it simpler and easier to follow. There was some changes in definitions to make them easier, trying to use more real-life words, if you will. And then the shortened, which is always my favorite part, 180 pages down to 60, I think, 58, whatever it was, which was very exciting. And then making sure, like we said, on the alignment, making sure that the terms that we're using in the SEC guidance and the standard were in alignment. We think that was important. Okay, so the effective date, Cindy, you went through it great earlier.
Thank you. There's a lot to keep track of, so probably a good idea to remind people again.
So the AS5, the rule, the amendments, all those three pieces are effective for audits ending after November 15, 2007, on or after. Early adoption is permitted. And the one tricky part, and this is because of the change in definition to material weakness, because we changed it, the SEC changed it, it became effective for management with the SEC's change as of the date that their rule took effect. So if we waited until November 15th, then management and the auditor would be working with different definitions, which really didn't work. So anybody who chooses to continue using AS2 up until that November 15 date, they should use the new definition immediately so that we have both management and the auditor using the same. So that's the kind of little tricky bit there. And then I'd like to talk a little bit about the steps for implementation and what the PCAOB is doing in that area. First is monitoring the firm's response to AS number 5. We started communication immediately with the firms to understand what are they doing to re-challenge their methodology, to get talking to their own folks to understand what those people are doing in the field. When are you going to start planning under AS5? When do you think you'll be able to make those changes for AS5? And what we found in a lot of cases is that people began immediately using AS5. We had because of the AS5 approval by the SEC, we came down to the approval date. People were waiting, calling, do you think it's going to get approved? So it was nice to see people working so quickly to implement AS5. And we're going to continue to monitor it. We're at the very beginning of the implementation. We'll continue to monitor that all the way through a bunch of different ways, not just discussion with the firms, but feedback we received from events like this, the questions that people ask inform us of how things are working. And then we also have the opportunity for working groups, communications. You know, we had a roundtable last year. Everything is open to what do we need to do to continue to monitor it. At this point, I think we're comfortable that we're getting a lot of input from people, the people we're talking to. We're getting some input from the firms, and that our monitoring will continue. But, you know, we're going to see what happens going forward. Second is continued outreach. I mentioned that things like this, which we're making sure that we have lots of people available to participate in these kinds of events, and especially our small business forums, which we do all over the country. And we're going to talk a little bit about that coming up. Third is to adjust the PCAOB inspection approach for AS number 5. You know, adjusting it includes probably first and foremost training our own inspectors, and we're working very hard inside the PCAOB to come up with a training program that is very robust, make sure to address everything that they need to know about the changes in AS5, how some of the underlying things were carried over, those principles, and how the auditor will be applying judgment coming out of AS5. AS5 offers a lot more principles that is going to require judgment, and really trying to get some meat on those bones of how you're going to inspect that. So we're working on that training program really hard. The other thing is our inspection guides, our process for inspecting. We're continuing to work on those things as well, and really focusing again on making sure to bring in to AS directly from AS5, and that any cobwebs from AS2 are being cleaned out of any of our inspection approach, and that it's an integrated process that will inspect both the financial statements and AS5 updated version. So a lot of work on that.
And Sharon, I know you're going to talk a little bit about the small company guide, but I'm going to tease our participants now and leave them hanging a little bit. I'm going to interrupt now and introduce our new poll questions. So at this point, I would like to introduce 2 more poll questions that our participants will have an opportunity to respond to. They will show up on your screens again for about 1.5 minutes each, as they did before. So I ask you kindly to quickly cast your votes. So the next poll question that we have for our audience is, has your client discussed with you how it approaches the implementation of SEC's guidance for management reporting on internal control, and how that will impact the external audit? So the question is, have you had those conversations with your clients? Yes, no, or don't know are your choices for answers. So again, you'll have about 1.5 minutes to react to this question, and then there will be another poll question that will show up on your screens. And that next poll question, so our 4th poll question of the day, is, based on your discussions with your clients, have they modified their approach to management's assessment of internal control over financial reporting as a result of the SEC's guidance to make it more efficient? And again, your choices will be yes, no, don't know, or not applicable. So cast your votes quickly, and we'll go over them later on in the program. And I think this is probably a good point to take a quick break. So as I mentioned during the opening, the revised CPE standards adopted by the state boards of accountancy require us to take attendance of all of you during today's presentation. So when you see those CPE codes appearing randomly throughout the program, please be sure to note them on today's program materials. And shortly after today's program, you will receive your CPE credit form, and there will be spaces on that form for the codes. So again, we're going to pop up our poll questions. You will have some time during the first half of the break to do that, and then you can take a few minutes break yourself. They'll each be up there about a minute and a half. So answer the 2 poll questions, take a quick break. I have, according to my clock, that it is about 2:04, so let's convene back here at 2:09. So with that, let's all take a short break. Thanks. Well, we're back from our break, and what I'd like to do is, Sharon, turn it back over to you and have you tell us a little bit about the coordination with the SEC.
Thank you. Well, we're going to, as we did all through the AS5 process, obviously we worked very closely with the SEC to make sure that we were coordinated. We talked about the alignment and making sure that the management guidance in the AS5 was in alignment, and we're going to continue to coordinate with them over the next year as we all continue to monitor this process and how the implementation of AS5 goes. So with that, I'd like to go ahead and turn it over for a little more detailed discussion of the guidance, and so I'll turn that over to Tom.
Thanks, Sharon. One of the things the board committed to a year ago, May, in our 4-point plan was to develop guidance for auditors of smaller companies, as well as to facilitate some further education for those auditors. And we began a process working with a large number of registered audit firms. Actually, 12 firms generously volunteered their resources to help us develop this guidance for auditors of smaller companies. Essentially what they've done is the people involved in this group are auditors who have experience auditing internal control of the smallest accelerated filers. So they're already familiar with auditing internal control in these smaller companies and the kind of issues that are sort of unique to small companies in implementing the internal control audit. So what they did was they helped us to identify a number of specific issues that are most difficult for auditors of smaller companies to deal with when trying to implement the internal control auditing standard. So rather than developing a comprehensive audit guide, the objective of this guidance is to help auditors deal with these specific issues, because we think that is what is going to be most helpful for auditors of smaller companies. So I think it's key to recognize that the issues and the proposed solutions to these issues all were developed out of actual practice guidance from people out in the field doing internal control audits. Let me just take a moment and go down the list of the issues and the things that we expect to cover in this guidance. First, we're going to provide a general discussion about scaling the audit. What sort of things should the auditor be thinking about when they're trying to scale the internal control audit to these smaller and less complex companies? The second area is evaluating entity-level controls. What do they look like in a smaller company? What kind of effect should they have in the smaller company audit? And how should auditors look at those? Assessing management override risks and evaluating mitigating actions also is going to be more challenging in a smaller company environment because there's a lot fewer people involved. And in fact, the higher level people within the organization are going to probably have a very important and integrated effect on the internal control. So we're going to try to help auditors understand, well, what kind of things should I look for when looking for a mitigating control for management override. Segregation of duties is another obvious area that smaller companies have trouble dealing with because of the smaller number of employees. So how should we be looking at segregation of duty issues in that smaller environment? Information technology is another area that I think auditors of smaller companies have asked for additional guidance. Considering financial reporting competencies, again, smaller environment, fewer people, a small company is less likely to have a lot of employees or the ability to have many employees on hand full-time who are expert in all accounting areas that may be affecting their company. So we want to provide some help for auditors to understand, well, how do I look at a company that maybe is looking to outside service providers to help them complement their own internal competencies in these areas? Documentation is another important area. We think in many smaller companies there's going to be less formal documentation associated with the design and operation of internal control. So how do we deal with that situation? And then finally, what do you do when you are in a situation where the company just really has poor internal control and there are pervasive internal control problems? And how does that impact the auditor's ability to finish the internal control audit and the impact on the auditor's reporting responsibilities, as well as the effects on the financial statement audit. So these are the areas that we would expect to cover in this guidance.
Well, and the guidance sounds just wonderful, and obviously a lot of communication and coordination, as we've heard all day today, between the PCAOB and the SEC, with staff at both of those organizations, with auditors. And our two poll questions that we asked right before our break also had to do about communications that auditors had with their clients. And so we have the results of those two polls, and I'll share those with you quickly. Remember, the first, or the third question that we asked, the third poll question that we asked was, has the auditor's clients discussed with their auditors the approach that they're going to take implementing the SEC's guidance for management's reporting on internal control and how that will impact the external audit? And 57% of our respondents said that they indeed have had those conversations with their clients. 25% said they have not yet had those conversations, and then 18% said either they didn't know or that was not applicable to them. And then the fourth poll question that we've asked today was, based on the discussions with your clients, have you modified your approach to management's assessment of internal control over financial reporting as a result of the SEC's guidance to make it more efficient? And 39% have said yes, 29% said no, and 32% said no, they don't know, or that it's not applicable. So interesting results. It sounds like while there is some good communication between the auditor and clients, that there could certainly be some more. So we'll look forward to seeing how that goes as time comes closer.
Well, I have just one more thing I'd like to cover before I turn it back to you. Sort of make a plug, if you will, for the PCAOB forums on auditing in the small business environment. That also was one of the things the board pledged to do back in May of '06, that we would continue those forums. Now, many of the participants in this program are likely familiar with those forums. This is, I think, the third year we've been doing that. We schedule these about 10 times a year throughout the country, where we meet with auditors of smaller public companies, as well as representatives and audit committee members from smaller public companies. And we have 3 of those forums left this year, one in New York, Chicago, and then Washington, D.C. And slide number 21 actually has that information listed. But some of the things we cover in these forums include AS5. We spend a lot of time talking about the new standard on auditing internal control. We also provide a general standards update, as well as just an update on what's new at the PCAOB that auditors and public companies should be interested in, as well as providing some insights about what we call potholes, if you will. Through our various travels, we've identified areas where we think auditors of smaller companies need to be, in particular, it would be helpful for them to pay attention to. And I think people have found that very helpful. And this year we also are talking to people about the board's strategic plan. So we think people would be very interested in what the board's thinking looking out over the next 5 years or so.
Well, unfortunately, we don't have a poll question on that, but I'm sure that if we did have a poll question asking our participants what their thoughts were on the PCAOB's forum around the small business environment, we would have an overwhelming positive response, because in all my travels, I hear nothing but accolades for that program. And so the PCAOB board and staff should definitely be commended for those programs. They're really wonderful and I know very helpful. So with that, I'd like to turn it over to Trent. In your introduction, you had mentioned that you view 404 improvement as a three-legged stool. And so we'd like to hear a little bit more about that, if you're willing to share with us.
Sure. You know, I talked about the idea that there are 3 legs to this 404 improvement stool. I could probably add a 4th leg for the smaller companies in the form of the guidance for auditors of smaller companies that's forthcoming from the PCAOB. But in a broader context, when we look at what's been happening over the last 18 to 24 months, certainly the PCAOB's issuance of AS5 is a major step forward for auditors in helping improve the efficiency while maintaining the effectiveness of the audit of internal control. But that's focused on what the auditor needs to do. And there's another element of what the auditor needs to do in auditing internal control, and that's understand what good internal control looks like. And so as it relates to this presentation, I want to look at the SEC's guidance for management, but look at it from the auditor's perspective. What can the auditor garner from that? And I want to talk about the COSO guidance on monitoring that was recently published in the form of a discussion document. When we look at the SEC guidance and the PCAOB guidance, they were both developed concurrently by different groups, but they were intentionally made to be consistent, at least not conflict with each other. And Sharon did a good job earlier of pointing out where there are justified and needed differences between the two, but where terminology and the like was kept as consistent as it could possibly be. Both of those, it's important for auditors to note that both of those documents, AS5 and the SEC's guidance for management, are all about supporting an opinion on the auditor's part or an assertion on management's part as of a point in time. It's what do you need to design and implement in order to audit internal control or issue an assertion on internal control as of the end of your fiscal year. COSO is taking a broader look at this whole equation, and I think the board recognized probably close to 2 years ago that there was a general lack of understanding about what the monitoring component of the COSO framework was really meant to accomplish. When you go back to the 1992 COSO framework, it says that monitoring is there to ensure that internal control is effective, that it continues to be designed and operated effectively. With that definition in place, I think COSO believes, and I think rightfully so, that if a company effectively monitors internal control, forget Sarbanes-Oxley even exists for a minute, if a company effectively monitors internal control, then in essence they ought to be in a position at just about any point in time to say whether or not they have good internal control. And so then what it takes to issue an assertion at the end of the year really shouldn't be all that onerous. And I think that's what Congress intended all along when they passed Sarbanes-Oxley with Section 404 in it to start with. So what COSO really wanted to do was further develop guidance around the concept of monitoring internal control so that management could then use that effective monitoring not only to support assertions about internal control, but for all of the other benefits that good internal control brings to a business. Benefits to operations and compliance with laws and regulations, benefits even to their strategy and how they conduct their business. So certainly Section 404 and all the issues that surrounded it was the impetus that got this COSO project started. But from the auditor's perspective, there is value to the auditor in knowing what good monitoring looks like. Because when you find good monitoring, and I'll get into an example here in a minute, and I'm on slide 22 of the presentation here now. But when the auditor recognizes good monitoring in an organization, then that automatically gives them an area of focus for their audit, which can pull them out of some of the detail. And hopefully the example that I'll give in a minute, albeit a very high-level example, will help bring that to light. Before I get into the COSO guidance, though, I want to cover the SEC material. I should say I have covered my presentation material with the SEC, although I don't purport by any stretch of the imagination to represent the SEC here. I have at least covered the material with them.
So not only are Sharon and Tom speaking for themselves, you're not even speaking for the
I'm
SEC.
not even, that's right. I'm not, and I'm not speaking for COSO either, but hopefully they'll agree with what I have to say. I'm on slide 23 now, and we're going to spend a few slides talking about the SEC's new interpretive guidance for management. It was proposed in December of 2006. They received over 200 comment letters in a comment period that ended in February, and then, of course, it was approved by the Commission in May of 2007. So it's been out there for a while, but I still get the sense in my travels that there's not really a firm understanding of how to take it and implement it. And I think there's a reason for that. When we go to slide 24 here and we look at some of the key attributes, the first attribute of the SEC's guidance for management is that it's principles-based. Now, you'll hear the same thing from the PCAOB about AS5. I think one of the challenges associated with developing principles-based guidance, and I've found this to be extraordinarily true as we were developing the COSO guidance, is the difference between principles-based and rules-based is not as bright-lined as some people might think. Principles-based guidance works when everybody understands, is in general agreement with what the principle means and what it takes to achieve the principle, what achievement looks like. And without that consistent understanding, then nobody really knows whether the principle was achieved or not. So what happens when we put a principle out there is that the first thing that people do is they start asking, okay, what do I need to do to achieve the principle? And so we start giving examples of how to achieve the principle, and before too long, you've actually developed rules. You know, the more you tell people how to achieve the principle, the closer you get to issuing rules instead of principles. And so I think what the SEC has done with their guidance is I think they've done a very good job of providing some high-level examples without boxing people into a rote or a set program that they have to accomplish. The SEC's guidance helps management design and implement an effective evaluation as of a point in time about their internal controls. And hopefully the COSO guidance does that too, but in a broader context. The SEC's guidance, similar to the PCAOB's auditing standard, directs the attention to the areas of the highest risk, and it allows the company to tailor their evaluation to their facts and circumstances. It really has to be that way. When I talked earlier about the General Motors versus Joe's Motors example, there have to be differences in the way they implement internal controls, and there have to be differences in the way they evaluate internal controls, because there are just different levels of risks in those organizations. And the SEC's guidance does a good job of really trying to articulate what that might look like. It provides some guidance on supporting evidence and documentation, highlighting the fact that documentation is important, supporting evidence is important. A company, when they're supporting an assertion about internal controls, there needs to be a reasonable basis to be able to go out and say, yes, this is why I believe that I have effective internal controls. It's not just a gut feeling that says, I think I have good internal controls because we have a good people and we haven't had a problem in the past. There really has to be some level of support behind it. But the SEC guidance doesn't go so far as to articulate exactly what that looks like, because it's going to be different for different companies. It provides some guidance for evaluating deficiencies, and which, again, is not mandating a certain way to evaluate deficiencies, but provides some general guidelines that I think all of us can agree with are reasonable guidelines for what material weaknesses might look like versus other types of deficiencies. Importantly, the SEC very clearly states in their document that they did not intend the management guidance to replace control frameworks, and the guidance developed around those control frameworks, like the COSO framework. In fact, they encouraged the further development of guidance from frameworks like the COSO framework, which is exactly why COSO has proceeded forward with the project on monitoring internal controls. And then finally, the SEC has stated in the document that using the guidance is voluntary. In other words, it's not a rule that was implemented by the SEC, it's interpretive guidance. And so if a company is already doing more than the interpretive guidance would suggest, and there are a lot of companies out there that were already doing more than what the interpretive guidance would suggest and really didn't want to change, then I think the SEC would say that's fine. As long as what you're doing is enough to support your assertion, then that's fine. But it does provide some general guidelines. I wouldn't call it a safe harbor or anything like that. It just provides general guidelines, a framework for how to support a point-in-time assertion about internal control. So as I move on to slide 25, this is the big entity-level control slide, and both Tom and Sharon talked earlier about the concept of entity-level controls. I'll tell you, as the profession, the auditing profession, I think the financial reporting profession, has struggled for some time with this notion of entity-level controls. When we realized that everybody was diving too far down into the details, we were looking for a way to get out of those details. And one of the ways to get out of those details is to take that top-down risk-based approach. And so we started talking about entity-level controls without really ever defining it. But if you think about what entity-level controls are, it's those things that happen at the top of the house, those things that senior management is most concerned with. And you would think that senior management, if this is a well-controlled organization, senior management should be focused on areas of higher risk. And if that's the case, then certainly those things that operate at the entity level should be a good starting point for for informing your risk assessment at a minimum, and second, for seeing what management does to make sure that those highest risk areas are well controlled. Most companies are fairly well controlled. They may not be perfectly controlled, but they are fairly well controlled. And so beginning with the entity level controls can really help improve the efficiency of your audit of internal controls, and certainly of management's evaluation of internal controls. without reducing the effectiveness. In fact, I might argue that it improves the effectiveness of the audit because it gets you focused initially on those things that management has already articulated are very important. That's why they're entity-level controls. So when we look at what these things are, the SEC and the PCAOB have now helped define what entity-level controls are. I think there was a belief out there at some point that the concept of entity-level controls was limited to budget-to-actual comparisons, that was an effective, the culminating entity-level control. And entity-level controls are much more than that. And so what the SEC and PCAOB have done is they have broken down entity-level controls into these three buckets. The first are those pervasive indirect controls that we talked about earlier, that the concept of tone at the top. Those things that for an auditor really help inform the risk assessment process. I said earlier I haven't found too many audit partners that have said that my client has terrible tone at the top. Where tone at the top is really strong, then that really, I call that a foundational control. It really supports the rest of the operation of the internal control system. And so it's critical that it be there. But an auditor is probably not going to reduce their audit testing because of strong tone at the top and strong entity-level controls. They certainly would increase their testing if that wasn't present, but it's probably not going to provide a lot of room to reduce testing. But the other entity-level controls, as we start getting down into these other levels, certainly provide an area of kind of laser focus for the auditor. The second level of entity-level controls are those controls that monitor the effective operation of other controls. And when you hear that, you ought to really think about the COSO monitoring guidance, because that's really what that's all about. If management is effectively monitoring internal control, then that monitoring is telling them whether the internal control is operating effectively. And it does more than that, and we'll see that in the example that I give in a minute. So if they're already monitoring it, and that monitoring works right, then that tells management and can tell the auditor that the underlying internal controls are working. So there ought to be a focus there. And again, I hope the example that I give in just a minute will help that. The third level of entity-level controls are those controls that operate with such precision that they themselves would prevent or detect a material error from getting into the financial statements. And certainly, if management has an entity-level control that they do at the top of the house that would serve as that roadblock for material errors and would catch those material errors, then that can reduce the amount of effort that you have to spend auditing earlier controls, because you have a control that can reasonably prevent or detect the error from getting into the financial statements. And we'll see in the COSO guidance, when you look at it, that we actually take that concept a step further, and that even below the entity level, if you have a really strong control, even at the transaction level, that could prevent or detect earlier errors, then you ought to focus your monitoring efforts on that control and maybe improve the efficiency of how you monitor some of the earlier internal controls.
Great. Trent, I know as we move on to slide 26, you're going to talk a little bit about documentation and evidence. And I need to interrupt here and talk a little bit about documentation and give our listeners and our participants the next CPE code. And that CPE code is ALL4NO5. Again, that's ALL4NO5. And we will tell you how to evidence your documentation a little later on in the program. So with that, I'll go back to you, Trent.
Okay, thank you. I'm on slide 26 now. And the SEC's guidance does talk about documentation and evidence. Again, it doesn't prescribe how to document or what evidence is necessary. But I think it's important, and I think Sharon and Tom covered this earlier, what management does to evaluate their internal controls can help the audit process. It can make the audit more efficient. So it is beneficial for the auditor to review that material, to use it on the front end to inform their own risk assessment process, and potentially help use the work of others in some places to improve the efficiency of their audits. The SEC guidance would say, again, that management should support their assertion, and that should, of course, involve some documentation. The level of documentation can vary, but I think it's important for companies to take into account what impact that documentation could have on the audit. In other words, it may be cost beneficial in total to document something so that the auditor can then use it, because it will make the audit process more efficient and ultimately cost less than it costs just to document the documentation. Of course, the nature and extent of documentation is going to vary based on the size, the nature, and the complexity of the company. We talk about the same concepts in the COSO guidance. An important concept, and it's hard to articulate in a brief sense, but the evaluation of internal control is done either through ongoing monitoring that's baked into the operations of the company or through separate evaluations that are done at some periodic intervals. And there is value to both of those types of testing. The SEC guidance does a good job of highlighting those things, and the COSO guidance helps to articulate when a company might implement one versus the other. We move on to slide 27, and one thing you'll note in this presentation, in 30 minutes it's really not possible to deliver all the material that's in both of these documents. Really what I want to do is give people a flavor for what's in there so that they can go pull it out and read it for themselves. The SEC's guidance, I mentioned earlier, includes a framework for evaluating control deficiencies. It also lists indicators of possible material weaknesses that are consistent with the indicators of possible material weaknesses that the PCAOB has put forward, things like fraud by senior management, restatement of the financial statements, the identification of a material audit adjustment by the auditor where the company's internal control system would not have caught it, or ineffective oversight by the audit committee. And those concepts have been relatively consistent over time, but things that I think it's important for the auditor and for management to keep in mind. One thing that the guidance does reiterate the same disclosure requirements that have always been in place in terms of management has to disclose that it's responsible for internal control. It has to disclose whether internal control is effective or not. Has to disclose the framework that they use, like the COSO framework, if they use that, for evaluating the effectiveness of internal controls. And they do still have to reference the auditor's opinion on internal controls. And one final thing that the SEC wanted me to note is that they are still seeing disclosures about weaknesses of internal controls that really don't do an effective job of describing the nature and impact of the weakness. Where there are material weaknesses in internal control, the SEC would expect that that disclosure would articulate what that material weakness really means to the organization. And they're still seeing in some cases, some weak disclosures about material weaknesses. One last thing that the SEC wanted me to mention, and hopefully many of you have seen this, the SEC has revised their FAQ series, their frequently asked questions series. They eliminated 12 questions from that were either redundant or were no longer necessary because of new guidance. They renumbered the remaining questions, and they added 4 more questions associated with foreign private issuers. So you can get those revised FAQs on the SEC's website.
Yeah, I think that, as Trent mentioned, there's a lot to read, a lot to digest, and he was able to give you a highlight of what's out there. I know that the PCAOB, as you mentioned, Tom and Sharon, will be issuing the small company guidance soon, so that'll be additional reading for everybody when that does come out. So we all look forward to that. And that still doesn't cover the landscape because we also have COSO as well.
That's right. And I'm on slide 29 of the document now. You can find the COSO's discussion document on monitoring on their website at www.coso.org. I failed to mention earlier, and I have it on another slide in a minute, the SEC's guidance is available on their website. It's interpretive guidance, so you have to do a couple of clicks to get to it. And we have that website posted on one of these slides a little bit later for the SEC's guidance. Let's talk a little bit about the COSO guidance, and I'm on slide 30 of the presentation now. I mentioned earlier that the COSO board recognized that there was kind of a lack of understanding about what the monitoring component of internal control looked like. There is true value to the organization in conducting effective monitoring. Again, forget Sarbanes-Oxley exists for a minute. Effective monitoring of internal control tells the evaluator, and ultimately management, and management may be the evaluator, it tells them that whether or not internal controls are operating effectively, and whether or not even that they have the right controls in place sometimes. And that's important. I mean, if we look at it, if we just think of this in terms of operations, we would say it was a poorly run company that really didn't monitor the manufacturing of its good and the quality control over the manufacturing of its goods and services. The same thing holds true for internal control over financial reporting. There is true benefit to the company and ultimately, certainly to investors, for there to be a proper focus on the quality of internal control over financial reporting. And so good monitoring should help support that. Second, good monitoring encourages effective operation of controls. And I think we'll see that a little bit more again in the example that I get to in a minute. But when people know that the internal controls they're responsible for are being monitored, that they are subject to monitoring, then over the long term they are more likely to effectively conduct that control. And I think that's a very important element that we sometimes miss. And then finally, good monitoring just helps management manage or mitigate risk. And that's what internal control is all about. And so good monitoring helps to make sure that that's being done. And these are concepts that really should be true whether a company is subject to Sarbanes-Oxley or not. You'll see on this, the bottom of slide 30 here, this concept, and COSO did a good job in their 2006 guidance of articulating the COSO framework really as a process. It's not just a static cube that sits out there. It's a process that involves identifying objectives, assessing risk, putting controls or procedures in place to mitigate or help manage those risks, and then monitoring the whole thing to make sure that it works correctly. And that monitoring monitors the whole internal control system. It doesn't monitor just the control activities. It monitors the whole internal control system. And that's one of the points that we try to get across in the monitoring guidance.
Before we move on to slide 31, we do have a question from one of our participants, and that is, what would be an example of an entity-level control that would allow an auditor not to look below that control? So any thoughts that you could give us on that, Trent, and then we might ask Tom and Sharon also to opine on that. Can you think of any examples that would cause you not to go on?
Yes, certainly. In fact, I think the example that I'm going to use here in a minute.
Did I steal your thunder?
You're stealing my thunder. No, it's fine. But I mean, it's an excellent question, and I think one that is really worth exploring. I'm going to use an example of a reconciliation here in a minute, and I'm using a relatively simplistic example. But I think the best opportunity in the entity-level controls, in the three buckets, the best opportunity for auditors to get out of the detail is to focus on that second level. Those controls that monitor the effective operation of other controls. And I think you'll see that in the example that I present in a minute. Where you can find entity-level controls that operate with enough precision to prevent or detect errors, there's certainly huge opportunity to eliminate testing below those in some cases. But I think the best opportunity is going to be in that second bucket. But I'm interested to hear what the PCAOB has to say about that.
Well, I might just say generally, I think we discovered as a result of having a lot of dialogue with issuers and auditors about this question over the last 2 years that it's a developing area. There are some examples of controls that are company-level controls that operate in a way where they do, in fact, address the risk of specific financial statement assertions. I know Sharon has a good example of one. I'm not sure if we have time for it, but I think the principles articulated in the standard recognize that can be the case. So I think it provides companies with the ability for further development in this area, which I think is pretty exciting in and of itself.
Sharon, I think we do have time for an example if you have one.
Oh, sure, yeah. Well, I think if one of the examples that I always talk about as, and where does it fit in there is always a good question. By the way, you called it company-level controls. It's entity-level controls. You owe me a quarter. No. But where in the entity-level controls does this fit really depends on the precision and of how it operates. And that's why I like this example so much. So if you were talking about control at the entity level that actually reviews the journal entries, for example, you've got multi-divisions allowed to do journal entries down in the individual divisions, and they have somebody up at the entity level who's actually tracking, was it reviewed by the correct person, was the documentation filed? Well, now that on itself is a monitoring control, but then you have to ask yourself things like, well, what level of materiality are they cutting? Are they looking at every one of them? And then what procedures are they performing as part of that review? Are they actually looking at the reconciliation, or are they actually looking at the journal entries themselves, questioning them the way that a reviewer would? And so where does it fall along the spectrum of a control that really does has this underlying, the squishier controls, and where, or is it that perfect control that all by itself it does it? And you would look at things like, well, if it's clearly, if it's well under the level of materiality for the company and the person is actually looking at all those details about how well, how much information is there about this journal entry and following up on questions they might have, now you're getting closer and closer to the end of this could be on its own all you need to look at. If they don't meet that, though, it doesn't mean you throw that out, that monitoring control out, and say, well, that doesn't help us at all. It's not a perfect, entity-level control. Instead, you look at the value it provides as monitoring. And even going through that exercise of making sure that all those ones have been reviewed, all those journal entries have been reviewed, maybe it means that those individual divisions, you can do a little less testing, and your risk changed on that because you know there's this contributing evidence from this other control. And so that's the example that I really like because I think you can really see how it moves back and forth depending on what that company is doing with the control and how it's operating.
And Trent, before I give you your thunder back, I do need to give one more CPE code, and that code is CALIF22. Again, CALIF22. So Trent, back to you to talk about your reconciliation example.
Well, Sharon, your example was actually an excellent segue into the example that I'm going to use here, and I could easily have taken that one and plugged it into these slides, so I like it very much. It really helps articulate where we think monitoring can take us in this equation. So let's just take a simple example here. I'm on slide 31. I used a reconciliation example because reconciliations apply to every organization out there and something that everybody can really get their arms around. So let's assume for a second that there's a reconciliation control that's deemed to be important to the financial reporting process of a company. And let's further assume that the supervisor of the area is performing a review of that reconciliation. Now, getting to Sharon's point earlier, the level of that review can vary. So when we talk, we have to define what reviewing the reconciliation means. If they're just reviewing it to note initials at the top of the page, that's one level of review. But if they're actually looking at the inputs and the outputs and verifying that the reconciling items were appropriately addressed, that's a whole different level of review. And in the COSO guidance, we call that the persuasiveness of information that the evaluator or the person performing the monitoring is obtaining and evaluating to form their conclusion. The initials at the top of the page is not very persuasive information, but the more information you gather, the closer you get to the operation of the control, the more direct information you gather about the operation of that control, the stronger that monitoring is and the more it supports conclusions about the effectiveness of the controls. So let's look at the example here. And on slide 32, I want to articulate first what I think the true value here of this concept is. If that supervisor is effectively monitoring that reconciliation, then that monitoring does two things for him or her. One is it tells him or her whether or not the reconciliation is working effectively, and that's what they were really trying to accomplish. They want to make sure that the reconciliation is working. So that provides very important evidence to the evaluator. But the second thing it does, and I mentioned it earlier, is it encourages the person performing the reconciliation to actually perform it consistently. And without that oversight, without monitoring, I can tell you from experience what happens over a long period of time is a point comes up where, well, I'm too busy this month, I haven't had a problem in this reconciliation in the past, I'll do it next month. Or I'll just take these reconciling items and put them in a suspense account. And then they build up over time, and nobody's looking at them to make sure that they're being dealt with appropriately, and things fall apart. When that monitoring is in place, it encourages the effective operation of the control. And so from the auditor's perspective, you could almost argue that that really is the key control. Because if it works effectively, if it truly works, if the monitoring works effectively, then the auditor knows then by definition that the reconciliation is working. That's one of the conclusions that they're trying to reach. And they know that there's effective tone at the top and that the person performing the control has appropriate oversight. All of that is important to the whole internal control system. So let's look then at these next three slides. I want to walk through what typically happens in the early 404 implementation concept in this example, and then I'll show what I think it could be. In today's environment, hopefully not in today's environment anymore, but I think still in some cases in today's environment, when we look at slide 33, you'll see that, one, the reconciliation is performed. That's supposed to mitigate the risk. Then the review of the reconciliation takes place. Again, it depends on how persuasive that review is, but assume that that's a good review that's reviewing persuasive information here. Once we get beyond that, in today's environment, what is often happening is that companies have a separate 404 process, either internal or externally engaged, that comes in and they, number 3, test the reconciliation. And then they come back in and they also test the review of the reconciliation. And then the auditor comes behind them and the auditor tests the reconciliation. And then the auditor goes and tests the review of the reconciliation. And I could add a 7th point here. Sometimes the auditor then goes and reviews management's work. So how many times can we beat up this one risk? When the point really is, does that review, if that review works, then we know that the whole system is working right. And so let's look at the difference between a large company and a small company. Slide 34 shows how this might be done better in a large organization. We still have the same reconciliation being performed, that's step 1. The same review of the reconciliation, step 2. But here in this case, remember that there's a supervisor that's reviewing the reconciliation. Now this reconciliation is important to internal control over financial reporting. So the CFO needs to get comfortable and the CEO need to get comfortable that this reconciliation is working effectively. Well, perhaps the sum total of their 404 process is just making sure that that review of that reconciliation worked effectively. And then the auditor can come behind and do one of 2 things, not both, possibly both, but not necessarily both. They can use the work of others where management's already tested the review, or they might come in and test the review themselves. But we've already eliminated 2 steps in a large organization. I think for a small organization, as we get to slide 35, it can be even more efficient. In this case, in a small organization, that supervisor that performs the reconciliation might be a member of senior management. Probably is in a very small organization. It might even be the CFO. If that's the case, then they don't need to do anything else to get comfortable that the reconciliation is working, because that's what the review is intended to do to start with. And then the auditor comes back in and just tests the review. And so really what I want to do in these slides is just articulate the value of effective monitoring. If we will implement effective monitoring, which we should be doing anyway, whether or not Sarbanes-Oxley exists, then that step number 2 there becomes a very important element of supporting ultimately the assertion about internal control and for the auditor to audit internal control. So when we look at what the COSO project was intended to do, it had 2 primary goals. One was to help companies identify effective monitoring where it is currently taking place and take credit for it, because far too often they're not. And second, to identify where effective monitoring isn't taking place and help them figure out how to implement it. So we move on to slide 37. There's 2 phases to this project. The first is really a proof of concept phase, which was the issuance of this discussion document in mid-September. We're looking for comments on it. We're going to turn that back around in phase 2. We're going to have a second volume to this, which will actually have implementation tools, some case studies, and some more examples to help companies kind of see themselves in the guidance as opposed to just seeing the theory that's currently in the discussion document. And we're going to try to turn all that around sometime in the first quarter of 08. But certainly, hopefully, the discussion document itself can provide some value currently.
And the comments on that are due on October 31st?
The comments are due October 31st. As of yesterday, there were about 4,500 downloads of the document. So it's being fairly well read, and the comments are now starting to trickle in. Slide 38. The guidance really is designed to help companies answer for themselves 3 questions. It doesn't answer the questions for them. It's just like the SEC's guidance. It's principles-based. It's supposed to help you see the direction that you're supposed to head and what the end goal is. And that is, 1, you have to decide what you're going to evaluate, how you're going to evaluate it, and when and how often you're going to evaluate it. Those 3 things have to be covered by any monitoring program. And all 3 of those questions are going to be influenced by the level of risk and the importance of the identified controls. We talked about precise controls earlier, those that operate with a level of precision to prevent or detect errors. The COSO guidance talks about focusing on those controls even below the entity level, because those are the ones that are really going to help make sure that material errors don't happen. And then we look at really what effective monitoring looks like on slide 39, and this is my last slide here on the topic. This really summarizes the whole document. Effective monitoring, like the whole internal control system, starts with an effective control environment about monitoring. That's the right attitude about monitoring, and a focus on having the right people in place for monitoring. If you don't have that in place, you can't have effective monitoring. If you don't have that in place, you can't have appropriate risk assessment or appropriate control activities either. So we start with that effective control environment, and then we very quickly get into prioritizing the procedures, the monitoring procedures that we're going to implement based on the level of risk that is inherent in the system and the importance of the controls in mitigating that risk. And then finally, properly ranking issues that come out of that process and reporting the results of that monitoring, communicating it to the right levels within the organization. And in the end, you have effective monitoring. And hopefully, when you have effective monitoring, then all of those other benefits that we talked about earlier will accrue to the organizations and to the auditors. The last slide, slide 40 here, and we'll leave that up there for just a second, just has the websites for both of those documents, the SEC's link and the COSO link as well.
Well, Trent, thank you for sharing your thoughts on this. I know we're really particularly lucky to have you here with us, as you were appointed by the board to be on this group that actually put this guidance together and put it out for comment. So we're very thankful that you were able to share your firsthand knowledge and give us your insights.
Thank you.
So we just have a few minutes left. We do have a question or two from the participants that I would like to ask, get some quick responses from our panelists, and then we'll wrap up. One of the questions we have is, can the guidance on reliance on a prior year audit experience be applied to the initial year 404 internal control audit of a non-accelerated filer? So given that it's coming in for non-accelerated filers, can things that have been done in the past be relied upon as they come in?
Well, certainly you would look at what the financial statement results were from the prior year and bake that into your risk assessment. But that's really the only information from prior years that you're going to have to bring in that's the auditor's own work, which is really what you're focusing on. And so that would be kind of your baseline year that you're going to start from. You're going to do that with just that little bit of additional information, and otherwise you have to fill in and develop that information in that first year so that you can carry that forward in the next years.
Great. And then the last question that we have here, and Sharon, it's directed at you, but we can let others opine as well. And that is, the participant is looking for an example of how we might be able to achieve the objectives, understanding likely sources of potential misstatements by doing something other than a walkthrough.
Well, I think that, we get asked that question a lot, and it's the perfect example of that. You've taken something and you've deliberately tried to be principles-based, and everybody wants those answers. Yeah, exactly. And so I'm not going to answer that question, but I will say that I think you really are focused on not what you're really focused on. What do I already know about that area? What kind of experience have I had throughout the year in other ways that I might have touched that area at a quarter, and from the last year's work at the quarters that you might be involved in that process. And then at the year end, what are your total plans? What is everything you're going to do related to that process? And what do I need to do to achieve those objectives? And I think people can be hamstrung by, here's a walkthrough, but I can't imagine other things. But I don't think that I don't think that should limit them. I think they can look at the elements of the walkthrough and what piece do I really need to focus on? Do I need those? Do I have lots of experience talking through with management what's happened through the year? Am I familiar with how it might have changed? Now I probably need to pull a transaction. Or do I really need to get out? Like we were talking about earlier, the importance of those probing questions. Maybe what I really need to do is get out, do those probing questions, but I don't need to pull a transaction because I have a sample or something like that. You're really looking at what information do I already have, what do I already know, and what do I need to do to achieve these objectives. And the end game is always, did I achieve those objectives?
Very good advice. Well, we've covered an immense amount of ground today, and our participants are not going to be able to remember everything that they've heard today. So what I would like to do is to go around the table and ask each of you to give us your one or two key points, your one or two key takeaways for our participants. So, Tom, I'll start with you.
I might have more than two.
Okay.
But I will be
they would love to hear, I'm sure, as many as you care to share with us.
Right. Well, first and foremost, you need to understand the principles underlying AS5, and then recognize that you need to exercise professional judgment in applying those principles. The top-down perspective is really important because that's going to drive which controls you test, that you identify that need to be tested. So apply that top-down perspective, acknowledge that controls in a smaller organization can be different than controls in a large organization, and don't forget about those matters that are really important to internal control.
Excellent. Trent?
I would say that both with the SEC guidance and the COSO guidance is to really understand that effective monitoring is beneficial to the business as a whole, and that ultimately, as it relates to Sarbanes-Oxley in Section 404, that should provide the majority of the support. So we then look back into the monitoring of the organization throughout the year and at the end of the year and look to make sure that there is an effective risk-based focus on what organizations are really, what they really believe is important, and that they have some support for the conclusions that their internal controls are effective. And I think recognizing what effective monitoring looks like and taking credit for it, fixing it where it's not up to par, is really important and will help improve the efficiency of the whole internal control evaluation process.
And Sharon, your key takeaways?
Well, I would say we need to all keep moving the ball forward. We have some great things like we were talking about earlier. Think about what people, when they first came out with 404, what they knew, what they had as tools, and where we're at today with all the new standard, with the COSO guidance coming out on monitoring and focusing on that really tough area of these entity-level controls. All of that information, if we use it right, if we really re-challenge what we're doing and bring it into continuously improving this process as we move forward, I think that's where we're really going to capitalize. And so my takeaway is to please make sure you're re-challenging what you're doing. You may think you really understood the May 16th guidance and all these pieces individually, but keep re-challenging whether or not you're really getting the full benefit out of it.
Great. Well, I hope for all of you watching and listening that today's webcast, titled PCAOB Insights on Internal Control, a discussion on auditing standard number 5, has covered some of the important considerations, answered many of your questions, and resulted in confidence that you are better prepared to implement the new internal control auditing standard for smaller public companies. We've been very, very lucky to have special guests Tom Ray, Sharon Virag, and Trent Gazaway. I think that their expertise and their knowledge has benefited us all. So thank you so much for your valuable insights. For those of you who are interested in having your staff learn about the key issues presented today, we will make this webcast available on CD-ROM. We'll email participants with the details of how to get it, how to get the CD, and also in that email will be a couple of other things. First, you'll receive a CPE form for today's program. You should print out the CPE form, complete it, which includes noting today's CPE program codes. That's the 2 ALL codes for most participants, but the 4 codes for California CPAs, the ALL and the CALIF. Then make a copy for your own CPE records and either fax or email the original back to us at the address shown on the form. Your copy of this form is all that you'll need to be able to document your CPE credit. Also, the email will include a link to an online program evaluation. We do encourage you to give us your feedback so that we can improve other webcasts that we do in the future. Once again, thanks to all of our panel of experts, but most of all, thanks to you for your participation in today's program. I'm Cindy Fernelli of the Center for Audit Quality, wishing all of you a good afternoon.